Well, again, good afternoon. My name is David Ruffin. I'm the principal of IntelliCredit, and welcome to our session this afternoon speaking of navigating the new credit cycle and specifically the COVID-19 loans and emerging credit risk. Some of you have heard our webinars in a couple of time slots before in the last few months, but just want to reiterate how delighted we are in our team to be part of the extended Quick Rate family, which we joined in 2019 to establish this new division for the Quick Rate family on focusing in on credit risk and so forth. So what we're going to talk about today is obviously the COVID economic and credit environment that we're all working through, some key national trends, that are kind of the first results of some of the call report filings for first quarter 2020. Touch again on the final guidance of the risk review systems that was just issued by the interagency regulators. We'll certainly talk about what we think is a great solution for working through some of these credit issues, particularly the COVID-19 tracker. We're in the process of forming a new credit forum that we'd like to share a little bit with you, and we'll certainly conclude with how you can participate further in the IntelliCredit portal. So my background is credit, and again, one of the whole ideas of forming IntelliCredit was to make sure that a good technical offering was provided by people with credit backgrounds, and we're very proud of that. But I've been speaking on the speaking circuit for a number of years, talking about when would the then current credit cycle end. Nobody in their wildest dreams would have thought we would have been it would have been ushered in by such a black swan as the COVID-19 crisis, but it certainly has. You know, we've gone dramatically and nothing like this since the Great Depression in terms of having a very robust economy, full unemployment, the best in 50 years, down to, I think, as April numbers showed, 14.5, and could get worse. It effectively has brought, and I talk to bankers all the time and who believe very strongly that it's going to be very difficult to just snap back from this cycle instantaneously. And I think it is going to require each of us to look at a new game plan for credit, particularly as we've been on such a prolonged and very benign credit cycle leading into this. The good news is, of course, the financial industry has much more capital, much more liquidity, and far improved risk management systems than we've had leading into the crisis of more than a decade ago. And I think another aspect of this is no one can blame financial institutions for this crisis, and therefore there shouldn't be any expectation of punitive regulations coming as a result of it. There is no question that probably those of you on this call today have just been up to your necks scrambling to react to the COVID-related loans, the payment modifications, extensions, the PPP loans, and so forth. And we know that from talking with you, and we know that you basically had virtually little else to think about. But as the dust settles on this phase of this crisis and this part of the credit cycle, I think the reality of how do you manage going forward takes hold, and that's a little bit of what we'd like to speak about today. Some of the things that are byproducts of this is that loan growth opportunities are being seen is in place. Some of it may be the result, and that's also in the deposits have grown quite a bit in the last month or two. Some of it may be drawing down on credit lines. Some of it may be from a deposit standpoint that people are just not spending as much money on a retail basis. But, you know, irrespective of the regulatory relief that came forward at the advent of the crisis, I think it's important that financial institutions understand that you're not immune from compliance, reputational, operational, or even economic risk going forward. And I think this is the time to be vigilant on how you look at that from a credit standpoint. Even before the COVID environment came upon us, I have begun to realize how important commodity valuations are within the credit industry. In other words, what is the basic commodity that's being produced by certain industries and how are they valued? How does the economy particularly value that? For example, it was the commodity valuation of 1 to 4 family residential housing that collapsed that led us into the Great Recession. But in that same period of time, regions and states that were energy dependent or centered had relatively little stress during that period of time. So much of the credit stress is really exacerbated, I think, because of the underlying commodity valuations of whatever industry you're lending into. That kind of brings up the issue of concentrations because within the financial industry we tend to go with what we're comfortable with and what we're talented at looking at or what the market is giving us. And I think understanding the concentrations within our portfolios, and that goes well beyond just real estate concentrations, but also understanding correlations because it was really not just the tract development loans and the construction loans that frankly failed so many banks a decade ago. These were banks that had extended portfolios on correlated businesses that were related to housing. And so understanding those kind of indirect aspects of your portfolio, I think, is very important. Subset of that, of course, is industries. We're a big advocate of using NAICS codes to isolate within your portfolio, treat your portfolio as subsets of certain types of businesses. Obviously, service industries come to mind as one area. I think every bank or credit union is going to have a different profile of those various industries. Vintages, we learned this hard lesson a decade ago, and that was, unfortunately, some of the most toxic loans are made and booked at the very end of a good credit cycle, and therefore loans that have been made in the last year or two under arguably very, very robust economic times, I think, have to be looked at for potentially having more risk. Also, every credit professional on this call today probably understands what I'm talking about here, and that is the real art of understanding emerging credit risk is how you focus on risk migrations within the past categories. It's really the early detection of risk, because what you don't want to do is wait until those loans have become criticized classifieds. And that brings up the first red flag, and I think as we have a structural bias in our industry towards wittingly or unwittingly recognizing emerging credit risk, because we like to call it the conundrum of all loans are good loans until they're bad loans. Particularly in an environment like this, you don't want to be in that position because, as they say, if you're already at criticized or classified loans, those horses have left the barn. The real art of understanding and mitigating risk, I think, is understanding how credit risk is beginning to emerge, and that's really the heart and soul of IntelliCredit. I think we're going to have to close the books on what arguably people had thought of for the last 4 or 5 years, and that is regulators have been in our shops and there haven't been a single downgrade for a number of cycles of examinations. That, I think, given what we're dealing with today, will no longer be used or could be used as a proxy for today's underlying credit quality. We've certainly had a decade of subsidized low rates, and they're likely to go even lower, even though Chairman the Fed Powell said within the last day or so that the Fed had no intention of lowering rates again the rest of the year. But you know, and I know the smaller institutions sometimes struggle as rates go even lower. There's some immediate credit concerns that we've picked up on. Obviously, the service industries, perhaps with the exception of the grocery store groups, have clearly been hurt by this aggressive downturn. Hotels, travel-related industries, and so forth. Conventional retail, many of you on the call come from smaller financial institutions and will say, well, yeah, I know what you're talking about, but we had no exposure to big box retail stores or malls, shopping malls. We all know what e-commerce has done to that product base, but I'm here to remind you that I would say 90% of the strip kind of Class C or even Class D retail centers are financed at the community financial institution level. And those two have been potentially hurt by this crisis. Some banks, smaller banks, have looked to the LFT or leveraged financial transaction market. It's kind of akin to the shared national credit world to supplement loan growth. And even before this crisis, there was certain indications of cracks in the quality of those loans. So if you've got any exposure in that, they're largely C&I, commercial and industrial type participations or syndicated loans that certain institutions buy into. This may surprise you, nonprofits, but one of the unintended consequences of the Tax Reform Act passed in 2017 was the fact that in 2018, arguably an incredibly robust economic year, nonprofits suffered about a $68 billion reduction in charitable contributions. Now, why is that important from a credit standpoint? Many smaller financial institutions have, over the years, increased their lending to colleges, small universities, churches, YMCAs, a whole plethora of nonprofits, and of course, that's top-line revenue for those organizations. Agriculture, as we know, has been on an inflation-adjusted basis, has the least profitability and the highest debt that it's had as an industry since the mid-'80s, which was the last time agriculture was stressed. And that's exacerbated on top of that with trade issues and tariffs and so forth. Consumer credit quality is for the last 2 years has been showing some strain. Roughly 80 to 85% of the charge-offs, net charge-offs in the banking industry has largely been consumer-oriented. That's not a big issue at some level with some of the smaller commercial banks because they frankly moved away from consumer lending into more commercial, but certainly credit unions have significant exposure to consumer credit. So I do think that is an area that, and not only that, statistics are beginning to emerge that under this crisis that there are, working payroll level employees are suffering the most in terms of job loss and so forth. Certainly there's a heady rise in some CRE segment valuations even before the COVID crisis. There was, a regulator told me about a year ago, there was a haunting similarity in office space valuation to what was going on in 1 to 4 family just before the collapse a decade or so ago. And of course, given the COVID environment now where people are working from home, one would have to wonder where the real impact of office space or broader CRA as an industry, how it could be affected from a credit standpoint. Unfortunately, smaller institutions also have structural problems in dealing with problem loans, and that is one thing that we have to accept as we move into higher credit stress. One thing we do know from the empirical evidence from the last crisis was that banks and financial institutions that were late to the game in identifying their credit problems always lost more money. We spoke about concentrations, and we're going to use a little bit of time today to share some data that has come out of our sister division, Quick Analytics. We, in real time at Quick Analytics, keep up with call report filings. As you know, that was postponed from April 30th to May 31st. But we do monitor, and we're up to now about 90% of first quarter 20 call reports having been filed. So we're using some data off of that to give you some indications of some interesting trends. It is, again, with 10% not filed yet, there are some anomalies showing in terms of those banks that show over the guidance of the 300% in total CRE. But as you can see, there is an uptick generally. The blue line, the heavier blue line, is the national average in the first quarter in terms of CRE. So there in of itself, again, what I just said a moment ago in terms of the COVID effect on commercial real estate generally would need to be looked at in terms of where the exposure is vis-a-vis risk-based capital. In terms of the subset of that, which is the construction development loans, that traditionally always tracks demographic forces within regions. The Southeast, of course, has been traditionally the head of that because of where, of course, the negative to that was that that's where so much of the credit crisis emanated from a decade ago. But again, the general sense is that's moving upwards in terms of exposure to a risk from a risk-based capital standpoint. Other concentrations, multifamily, again showing a little bit of upward movement. C&I loans, significant. That could be, remember it's taking in some of the March numbers that could have been some COVID-related type of lending. It could have been the fact that credit lines were being drawn down. But I do think all of these charts, I think, lend themselves to taking back to your institution and trying to assess where you are from a risk perspective. Also in agriculture, of course, this is strictly the commercial banking industry's exposure to ag and farm loans, doesn't include farm credit systems or anything of that nature. There's always been, from my perspective, three kind of fundamental ways to look at credit quality at a financial institution. One is to start with the non-performing loans, which is the chart to the left, and to kind of use the analogy of the parlance of the day, which is the curve is bending. It's obvious that the curve in terms of the non-performing loans has begun certainly to flatten in the last few quarters. The Southeast, again, in orange, was where the preponderance of these have been just as legacy from the financial crisis. But as you can see, the next chart is, and so the first chart is your inventory of problem credit, right? You can do one of two things with it. You can either charge off the loans or you can reserve for them. And so charge-offs, as you can see, show a very lower spike in the first quarter, but that's not uncommon. The smaller financial institutions tend to have kind of a sawtooth way of doing charge-offs, and most of those occur at year-end. Reserves have indeed, unfortunately, begun to turn the curve upwards again. As you can see, the ALLL, or the reserves, as a percentage of loans, is beginning to creep up even in the first quarter, probably in recognition of the advent of the COVID crisis. So our belief very strongly is that now is the time to assess your credit risk. And even with the COVID loans, I think we're now moving into a phase beyond the booking and coding of these loans. Now comes the monitoring, which I think is going to be very, very important, and understanding what is the fundamental impact to your credit quality going forward. I do believe, not to be a doomsday predictor, that I think we are in a new and probably more treacherous credit cycle than people could, despite the fact that there's every indication that certain things in the crisis are improving and that the economy will, jobless claims are, as of this morning, were predicted to have flattened out. But my point there is most credit specialists don't believe this is going to just be instantaneously back to normal anytime soon from a credit perspective. I think we have to avoid the trap of managing credit by trailing indicators. Trailing indicators would be, in many cases, what happened in the fourth quarter of 2019, which is virtually meaningless from a credit perspective at this point in time. But I think you now have the power and the tools to be the captain of your own ship. And why I say that is it's very tempting in a crisis of this magnitude to consider it's so existential, so overwhelming that there's nothing we can do to affect the outcome. But every financial institution is going to have to come to grips with how this impacts your credit quality. I think it starts with understanding your position, quantifying it, and then most importantly, describing it before a regulator does that for you. And that's what we feel so comfortable about the solution that the IntelliCredit portal offers. And that is in concept, this is what it's all about. Obviously, we see data coming from two areas: public data, which is largely call report level information. Our sister division, Quick Analytics, has incredibly robust bank data and research tools to provide all sorts of slicing and dicing of public data. But again, as I shared with you before, IntelliCredit was formed largely to start looking at the non-public data, the data that's idiosyncratic to your financial institution, the data that doesn't emerge in a call report, but can be extremely informative in terms of particularly emerging credit risk. And the concept we apply to that is that it's also a link between what we call macro or very high-level data and transactional data. And we start with red flags, then that leads, as we often call it internally, as peeling the onion, to aggregate portfolio trends, and then leading to loan level detail. And the revolutionary thing that we have done at IntelliCredit is to actually take loan review or loan, what we call smart loan review, and take a deliverable or an offering that arguably for 40 years has been a standalone engagement that doesn't really relate at all to ongoing portfolio analytics, and make that a partner in terms of a tool with the ongoing analysis of your portfolio. So what does this look like? Red flags, which we have an example here coming out of Quick Analytics in their credit metrics tool, again using public data to indicate certain red flags. There are red flags that come out of the IntelliCredit portal. In this particular case, there's some illogic around pricing, where you might have, in this particular case, some of your non-owner-occupied commercial real estate at a risk grade 3 is priced higher than your risk grade 4. That's illogical pricing. Gives you the ability to figure out what's going on with that. Aggregate portfolio trends would be, and one of our most favorite looks on this is how are risk grades migrating, as I alluded to earlier in the presentation, in the past categories. Again, none of this is public information, but what this chart depicts is that from one year to another, in 3/31/2019 to 3/31/2020, you've had a migration already of risk towards the right, the bell curve to the right, which does indicate, and this can be done in our portal through the COVID loans. It can be any other subset of loans that can begin to indicate from a portfolio trend standpoint. The one thing that we always can do in the IntelliCredit portal is be able to drill down to what loans constitute either an anomaly or special concern to us from a credit risk perspective. An example here is a loan past due distribution on a particular loan officer showing 60 to 90 days past due, and then it has the ability to drill down on that kind of aggregate data point to what loans comprise that. So that's very, very important that we have integrated macro portfolio trends to all the way down to loan level detail. And again, the revolutionary part of the IntelliCredit portal is to take, if you're using Smart Loan Review, or we're doing this loan review for you, is we have the ability to take it down to individual loan review reports and even the findings of the minute exceptions that are identified during the loan review process. So again, this is the concept of IntelliCredit and the IntelliCredit portal, which is the portfolio analyzer and the smart loan review. In terms of loan review, it's a good segue into reminding participants on today's webinar that the Interagency Guidance, which includes all of the 3 major banking regulators and the credit union regulator, NCUA, issued a statement, finalized their guidance that was floated back last fall on May 8th of this year, to basically buttress what they consider to be best practices in the risk review systems applicable to all financial institutions. The good news here is we feel very strong that every aspect of the IntelliCredit portal has the ability to comply with these stated and suggested enhanced aspects of any credit review system in place at your bank. At this point, I'd like to hand it over to Larry Poole, Director of IntelliCredit, to talk in particularly about a solution that we feel very, very comfortable about relative to specific COVID-19 loan monitoring. Larry?
Yeah, thanks, David. Thanks, everyone, for joining us today. Really quickly, we began to see last month that while so many banks and credit unions were completely overwhelmed with just booking and accounting for COVID-19 loans, we really started looking 60 days out and saying, okay, what is this going to look like for managing COVID-effective loans once all these modifications have kind of settled down? We started receiving a lot of calls from financial institutions just getting us to opine on, okay, is this a TDR? Isn't this a TDR? This was early on in April, and I think those guidances have been put together now. But I sat in at the end of April on a webinar that I've got referenced here at the bottom, an Ask the Regulator webinar. It was a great hour-long webinar, and I'd really want to point your bank or credit union to that if you didn't listen in. All the major regulators were represented, included the NCUA. But what came out of that was this slide that's before you. We put this together. There's really two documents that kind of govern loans that have been modified that you as a financial institution do not to flag. And some of you have probably already seen this, but I think it's worth spending about a minute to just talk through it. So first, Section 4013 of the CARES Act really gave three guidelines that said if you're a community financial institution and you have a borrower that's been affected by COVID, you can proactively work with that borrower if these three guidelines are met. And one was it is related to COVID-19 modification, so it doesn't have to be the primary contributor. You could have a loan to the oil and gas industry, which had its problems, but they were exacerbated by COVID-19. So you could modify that loan and not recognize it as a TDR. Number two, that loan had to be current as of fiscal year end 2019. And then number three, that loan modification had to occur between March 1st or what they said was the earlier of 60 days after the termination of the national emergency or fiscal year end 2020. So those were the three kind of broad guidelines put out by the CARES Act. On April the 7th, Interagency Guidance was issued, which we've referenced here at the bottom, and they gave similar but a little bit different. They said you can modify a loan and it not be a TDR if it's one, COVID-19 related. Number two, it was current at the time of the modification program implementation, and they took a much broader approach than the CARES Act. Specifically, the regulators have said that the bank, they want to provide you with some flexibility to picking a point in time to determine was a loan current or not. So just know if you're on the call, a bank or a credit union, you do have some flexibility to determine what really specifies current at a point in time. And then number three, the Interagency Guidance has said that you can do these short-term modifications, and they've been pretty explicit in defining short-term as less than 6 months. As a matter of fact, as I've listened to regulators and read different papers, anything that goes over 6 months, even if you have a 3-month modification today and maybe you need to extend that for 5 months at the end of that 3 months, once you get over that 6-month modification, you've really crossed that threshold of short term, and now your bank needs to look at normal rules when accounting for TDRs. This is kind of the technical piece of what your bank can do for modifying loans. But if we go to the next slide, I want us to talk through a little bit about what does that mean from a credit perspective. So first, while the Interagency Guidance provides temporary accounting relief for TDRs, we've got to recognize that COVID-effective loans remain a hotbed for future and potential credit issues and credit losses. And as a matter of fact, regulators have said a couple things. One being, just because we're providing you TDR relief, we still want you to make the appropriate risk grade and credit call on that individual loan. So it's possible to modify a loan, it not be a TDR, but then you need to downgrade that loan as well. Regulators have also been really explicit, and David alluded to this earlier, and you saw it a little bit in the earlier slide, that even on these modified loans and pools of loans, while they're not TDRs, regulators are expecting you to account for that in your allowance, whether you're still utilizing incurred loss guidance or you've moved to the CECL approach. If there are recognized embedded risks within those modified COVID effective loans, that should be reflected within your allowance. One of the things that we've kind of realized as well when we're talking about 90 days from now, 100 days from now, regulators have been pretty prescriptive that we want you to track these loans quantitatively, so loan counts, loan balances, but we've got to quickly move to the mindset as credit professionals that 60 days, 90 days from now, we also better be tracking these loans qualitatively. And this gets back to what David had said earlier about being the captain of our own fate, understanding our position today as relate to COVID loans, quantifying our position, and then writing our own narrative before the regulator does it for you. So one of the things that we worked on in the last month, I wanted to take a brief moment here, and I'm going to take the reins from David and share my screen. Bear with me just one moment. So one of the things that we've worked on in the last 30 days is how can we put a tool in our credit unions and banks' hands today that can really help them not only quantitatively track their loans, but also qualitatively track their COVID effective loan portfolio. So what you're looking at today, this is what we refer to as the IntelliCredit portal. The IntelliCredit portal has basically two parts: Portfolio Analyzer, which is what you're seeing today. It also has this Smart Loan Review section, and I'll just click on this momentarily, which allows, if you're using this as a licensee or if IntelliCredit is performing loan review for you, it just allows you to easily log in, be able to see what reports are being utilized or being generated. You can easily click on the individual loans that we perform reviews on. But at a high level, portfolio or the IntelliCredit portal consists of Portfolio Analyzer and Smart Loan Review. What Portfolio Analyzer does, we've taken the ability, we start with a bank's core system file. Maybe you refer to this as your flat file, maybe you call it your core system tape. Various names for these, but we take and we get a data dump from your core system provider, and we're completely agnostic to that. We work with Metavante, Jack Henry, FAS, BankPack, others, and we take that core system dump and we ingest it within our software. What you're looking at right now is this Pawnee Community Financials, a fictitious institution where we've ingested 5 of their core system flat files. What our software allows you to do, we've then aggregated that data that puts you in the position to analyze your portfolio and not worry about the heavy lifting of aggregation. So just to give you some context before I move on to what I really want to talk about today, which is Portfolio Tracker, every thing that you see here on the left side is kind of a standard report that we think is an indicator of how to proactively manage emerging credit risk. And as David said, it starts at the top level, the red flag level, and you can drill all the way down to the most basic level. So just giving you some examples, here's the demonstration of the bank's 3/31/2020 flat file. Out of this 790 loan portfolio, which is $320 million, roughly 9 million in loans are past due. So if you wanted to see what those 9 million loans were, you can just easily drill down, and here are my 19 loans that are 30 days past due as of 3/31/2020. We've also given you the ability to look at, your portfolio in various ways. So if you wanted to see maybe the distribution of your portfolio by loan officer, Samantha Powell, if you wanted to see the list of her loans, again, you could drill down. And one of the things that you'll notice, so here's Samantha Powell's 282 loans. Over here in this far right column, this bank would be a subscriber to Smart Loan Review. So you can see that we've reviewed one of her loans in January. You click the hyperlink, and it's going to launch the individual loan review report that we did for this borrower, AE Associates. How this relates to COVID. One of the things that we've done right here, this is a distribution of the entire portfolio, 789 loans. But if you wanted to filter down, maybe you have a specific subset within your portfolio that you want to track, you can do that. So if I just wanted to tag and look at all my COVID-19 loans, whereas I have 789 total loans, if I just filter down to my COVID loans, now I have 140 COVID loans that represent $68 million in balances. Now remember, this is the qualitative or the quantitative piece, but we also need to be tracking this portfolio qualitatively. So this is what I wanted to spend the majority of our time together on, is this COVID-19 portfolio tracking. If you launch this link right here, what we've done, we've gone ahead and answered those regulatory questions for you. So this is the 140 loans within the COVID portfolio. As you can see, we have indicated how many days past due was a loan at fiscal year end 2019. We've indicated the reason for the COVID designation, and we've allowed you to input the date of the COVID-19 related modification. Over here to the far right, you've got a comments log where you can track what is actually going on with the borrower, and then you can even upload files that kind of support the narrative for that individual loan. Now, what I've seen from banks, if you can imagine, banks are, it's not uncommon probably at your bank or your credit union to have 100 or more borrowers for which you've done modification. This is very difficult to manage when you've got 10, 15, 20 loan officers that represent that 100 loan borrowers. What this would allow you to do, every loan officer at your bank would have a login. You can easily log into the portal, and as new and relevant information becomes available, you can log it here. So for instance, on this first loan, we've got our comments log says that the borrower contacted the bank on March 15th and requested a payment deferral. The loan officer log that on 3/31 they applied for a $30,000 PPP loan, and then on April the 15th they were approved for that PPP loan. If you wanted to add to this log, you could just scroll down here to the bottom. You would enter the date of your comment, and maybe let's do this 6 months in the future. Maybe you realize you have to downgrade this loan to a risk grade 5. You'd be able to add your comment, save your data, and once you close out, you'll see that it'll update, and it's keeping a comments log. You also can upload any relevant files. So here's 2 files where this is the file of the email where the borrower has actually requested the payment deferral. Again, we're just putting together a system that allows you in one place to add loans and track loans that have been COVID affected. If you wanted to add a new loan to the COVID tracking portfolio, I'm going to show you that process right here. I'm going to add maybe in 3 weeks, Linda Golden comes to you, or London Golden comes to you and says, hey, I need to modify, I need a short-term extension, I've been affected by COVID. You would just enter the days past due at 12/31/19. You could enter the date that the loan was ultimately modified, the type of modification, so 90 days interest only. We give you the ability to track NAICS industry code. We use the 2-digit code if you want to do that. The reason for the COVID designation, and then any comments that you had related to this loan. And then finally, if there's specific files that you need to upload related to this loan, you can do that. Once you save and close out, this loan has been added to the portfolio, and then whereas before we had 140 effective COVID loans, we now have 141 effective COVID loans. Now, when I add loans here and go back to the portfolio analyzer tool, what you'll see is now the COVID-19 loans also reflect the 141 loans that are in my COVID portfolio. again, if you wanted to drill down and say, okay, what are these 141 loans, you could easily do that. So one of the things that we think, and we realize that banks and credit unions have just been trying to keep their head above water, but we know that in the next 30, 60, and 90 days, we're not only going to need the regulatory requirement of tracking these loans, but we're also going to need just the perspective of credit professionals as we know this is a hotbed of risk, what is actually happening within these loans within the portfolio. So we would love to be able to demo this and more of the portfolio analyzer for your bank on a one-on-one basis, and we're happy to do that. So in just a moment, we'll kind of have a call to action about how we can do that. But for right now, I'm going to turn it back over to David Ruffin, and he's going to close us out here in the last 5 minutes.
Thank you, Larry. One of the things that we're very excited about and beginning to put together on our team is to establish a new LinkedIn, what we call credit forum, that would really be open to all interested credit professionals of any financial institution, and to be focused on discussion of topical trends and economic impact, just best practices, a sharing of just common interests about what's going on. This, again, on the presumption that we're going to be living with some of this credit degradation for some time to come. It's not a matter of trying to sell product. It's more or less an ability to just share best practice things. And we'll be sending out an email shortly with further details around how to join and how to participate in this credit forum.
So Dave, sorry to jump in on you. I don't see your screen. The PowerPoint's not up, and I want to make sure that the group.
Oh, sorry.
There we go.
How about that? There we go.
Yes, sir.
Sorry about that. And so anyway, you heard what the attributes of the forum should be. Look forward to the email announcing it and with some further details. And we're excited about that. So in closing, we've appreciated the time. I'm going to let Larry bring us to the end.
Yeah, so one of the things that we said, kind of time is of the essence with this. The regulatory window for tracking COVID loans is really between now and fiscal year end 2020. So we need to shift mindset from, okay, we've modified the loans, now how do we manage the loans? I was actually reading an article from a trade association last week, and it was probably a 1,000-word article that talked about all the technicalities of tracking your loans and what's the TDR and what's not. And at the very last paragraph was this quote at the bottom, which was almost a throwaway comment, but when I read it, I thought that's going to become more important than everything we've done in the last 30 days. And it just said this: while financial institutions don't need to report COVID-modified loans as TDRs, they must maintain records of these loans. It is likely that starting in Q2 2020 reporting, there will be some requirements to report these loans on these modified loans. Plan accordingly. So what we really want to do is serve our credit unions and our banks well by helping them plan accordingly. And that was the whole genesis of the portfolio, the COVID portfolio tracking tool that we just showed you. So our call to action to people in the bank today, we would like to give you guys kind of a no charge test drive of this portfolio analyzer and the COVID-19 portfolio tracking portal. And to do that, it's really simple. If you would contact us after this webinar, and we're going to throw up our emails and telephone number shortly. If your bank would be willing to give us a flat file or that core system snapshot, loan tape, an Excel file, whatever it is, however you're tracking your portfolio, if you will give that to us, we will do the heavy lifting on data ingestion. We'll stage it for you, and then we'll set up one-on-one 45-minute training sessions for your institutions to show you how the portfolio analyzer and the COVID portfolio tracking portal work. And then, if you like it, we'll talk next steps. If you don't like it, we've just, been able to jump on a demo and meet your bank, and you meet us a little bit more. So one of the things I will say, we've got heavy volume on this call today, and we do expect probably lots of credit unions and banks to take advantage of this. So just bear with us as we're working through this queue. But we really do think that it's time to shift mindset of how do we just not only modify these loans, but now how do we manage these COVID effective loans? So last slide here, David, if you want to.
Yeah, please reach out to us. We would love to. I think a picture's worth 1,000 words, and particularly with your data involved, we certainly would negotiate a confidentiality and data use agreement with you, and we would look forward to, again, showing you that on a shorter term basis as to how you could help manage and monitor that information leading with the COVID, but also that would be an example where you could see the other attributes of the portfolio analyzer as well. So please, thank you very, very much for attending again today, and we look forward to hearing from you in the near future. Here are our emails for myself, Larry Poole, and David Littleton, who is on the call today, as well as manager of our IntelliCredit. Again, thank you so much for attending, and stay healthy.